Ever thought about diving into the world of being a landlord? Well, get ready to invest some cash upfront before you start seeing those rent checks roll in. But here's the silver lining. Some of those expenses you might have brushed off as a non-deductible can actually come back to benefit you come tax time. Yup, those startup costs can turn into tax deductions, putting a smile on your face and some extra dollars back in your pocket. In this video, we'll guide you through the ins and outs of deducting the initial costs incurred when setting up your rental property, helping you navigate the tax code with confidence. Let's move forward. Ever wondered about those startup expenses when diving into a new rental property business? Let's break it down. Unlike regular operating costs for an established business, startup expenses happen before you even offer your property for rent. They're like the groundwork you lay before the big launch. Now, since these expenses are considered an investment in your business's future, you can't just deduct them all in one go. Nope, they're classified as capital expenses, meaning they'll benefit you more than a year. But don't worry, you can deduct up to $5,000 for these startup costs in your first year of business, then spread out the rest over the next 15 years. Pretty sweet, right? Now, what exactly counts as a startup expense? Well, there are two main types: investigatory expenses and pre-opening expenses. Investigatory expenses cover the research phase, like hiring a market research firm to scope out the neighborhood demographics or traffic patterns. But once you've got your eye on a specific property, expenses to acquire it aren't considered startup costs. Pre-opening costs cover a range of things from office supplies to utilities for your rental property before it's even on the market. Think office rent, phone bills, landscaping, even recruiting and training employees. Yup, it's all part of the startup game. Just remember, while professional fees like lawyer or accountant services count, fees for purchasing a property or setting up a business entity aren't considered startup expenses. So there you have it. Startup expenses might seem like a headache at first, but with the right know-how, they can be a valuable deduction for your budding rental property business. Alright, let's dive into some nitty-gritty details about costs related to opening a rental business. Now, not all expenses are considered startup expenses, but don't worry, many of these costs are still deductible, just with different rules applying to them. First up, we've got real property and other long-term assets. These are the big-ticket items that will last for more than 1 year, like the property itself and any long-term personal property you buy for it, such as appliances or furniture. These are considered capital assets and their costs are capital expenses. You'll need to depreciate the cost of these over their useful life, which can vary depending on the type of property. Now, the largest single expense you can't deduct as a startup expense is the cost of your rental property. These includes not just the purchase price, but also a bunch of related expenses like bidding costs, appraisals, inspections, and more. Instead of deducting these right away, you add them to the property basis and depreciate them over time. When it comes to real property improvements, those costs aren't startup expenses either. They're capital expenses, but they'll need to depreciate as well. Now, let's talk about travel expenses. While most travel expenses to get your rental business going are deductible startup expenses, travel costs specifically related to buying the property itself are considered capital expenses. Interest and taxes also don't fall under startup expenses. You can deduct these costs as you pay them once your real estate business is up and running. Lastly, organizational costs like forming a partnership or corporation aren't part of your startup costs either. But fear not, you can still get some tax relief here. You can deduct up to $5,000 of these costs in your first year of business and spread out the rest over time. Whew, that's a lot to take in. But understanding these distinctions can really help you navigate the tax landscape when starting your rental business. Alright, let's talk about how you can handle your startup expenses when you're ready to kick off your rental business. You've got a couple of options here. First on the day of you officially start your rental business, you can choose to deduct your startup expenses. Now this deduction is a bit formulaic, so bear with me. You can deduct the lesser of your startup expenses or $5,000. But if your startup expenses exceed $50,000, this $5,000 deduction gets reduced. Then whatever is left over can be amortized over a 180-month period. Let's break it down with an example. Say you've got $53,000 in startup expenses and you officially launch your business on October 5th. For your first year, you'd get a deduction of $2,000, which is $5,000 minus the $3,000 excess over $50,000. plus an amortization of $850 for 3 months. Now, if you have $55,000 or more in startup expenses, you won't get an immediate deduction. Instead, you'll spread out the deduction over the 180-month period. Making this election is pretty straightforward. Just claim your startup costs as other expenses on your Schedule E or another suitable return. You don't have to label them specifically as startup expenses for the election to count. But if your startup expenses exceed $5,000, you'll need to fill out and attach IRS Form 4562 to your return for the first tax year of your business. Now, if you'd rather not deduct your startup expenses right away, you can choose to capitalize them instead. Just make sure to clearly do this on your tax return for the year your rental business begins. And remember, once you make this choice, it's final. Your startup costs become part of the tax basis of your rental business, and you can't change your mind later on. So weigh your options carefully and choose the approach that best fits your business strategy and tax situation. When it comes to expanding your rental business, understanding how the IRS views these expenses is crucial. Here's the scoop. If you're expanding within the scope of your existing rental business, those costs are considered ordinary operating expenses and can be deducted right away. However, there's a catch. The expansion must align with what's considered normal for your business. Now, here's where it gets a bit tricky. The IRS and tax court have a strict definition of what constitutes an existing rental business. They say it's limited to the geographic area where your properties are located. So if you're buying property in a different area, even if it's just across town, it's seen as starting a whole new rental business. And that means the expenses for expanding in this new location are treated as startup expenses. Now, here's the good news. Most rental activities do qualify as businesses. So if you're renting out properties with the intention of making a profit, bingo, you're likely eligible to deduct those startup expenses. But hold on a second. It's essential to distinguish between investors and rental property owners. Investors who are just dabbling in real estate typically can't deduct startup expenses. However, if you're actively managing your rental properties, you're in a different boat altogether. So if you're in the game of actively renting out properties and managing them as a business, those startup expenses can be a nice little break for you. Just make sure to keep track of all your expenses and consult with a tax professional to ensure you're maximizing your deductions while staying on the right side of the IRS. Before you embark on your rental property journey, understanding startup expenses is crucial. While they may not be immediately deductible, you can still benefit from deductions of up to $5,000 initially, with any excess spread over 180 months. Remember, these expenses cover investigatory and pre-opening costs, excluding property purchases. Once your business kicks off, depreciation kicks in for property and long-term assets. If you're expanding an existing rental business in the same area, rejoice. Immediate deductions of expansion expenses awaits. Keep these pointers in mind to optimize your tax deductions and thrive in the rental market. Happy renting, and don't forget to subscribe for more insightful content like this.